Thank you for the introduction, Jim. And I'll tell you, I know we're at Tommy T's Comedy Club, but this regulation is no laughing matter. So hopefully today you'll have a little better understanding.
Can you hold up the mic? Hold up the mic. Hold it up.
Is that better? Yes. All right. So hopefully after today's session we'll have a little better understanding what exactly the regulation is and some of the changes you're going to expect to see in the industry whenever this goes live. So we'll talk about a few things today, the first of which you may have seen recently here in the past few weeks about the date change for the effective date moving from August 1st, which was the initial effective date. I'll talk about that and what drove that. I'll also give you an overview of what the rule actually is. I won't go into too many details there because it gets a little dry pretty quickly, but I'll hit on some of the key things that will impact you and some of the baselines that are really driving a lot of these changes. Then we'll tell you what some of the changes that the lenders will be making. I'll try to generalize it as much as possible to make it applicable to any lender, and then obviously we'll take questions at the end. So you'll oftentimes see this referred to as TRID or Respa Tila, and basically what this regulation does is it combines those two regulations, Tila, which predominantly regulated the lenders, and Respa, which predominantly targeted settlement. And you'll see that there's a big shift in the liability now. So a couple things. One, there are two new disclosures. The new loan estimate, which is replacing the initial truth in lending document and the good faith estimate. Again, combining those regulatory documents into one regulatory document. And then on the back end, the final truth in lending document and the HUD-1 are being combined and replaced with a new document called the closing disclosure. So how many people, have you guys actually seen the documents, the new disclosures? Yeah. Seeing some head nods, that's great. So what you probably noticed in just a quick look and glance at those documents, there's consistency and uniformity between the documents. So the customer can look at that loan estimate that they got at application and then look at the closing disclosure that they got at closing and be able to tell what may have changed from the application to closing. A task that really can't be completed easily by an average consumer today between the GFD and the HUD-1. So you'll see throughout this regulation, the customer is front of mind, which should be no surprise since this is issued by the Consumer Financial Protection Bureau. So the documents are a real win for the borrower, just simply on the format and the changes that have been made in that regard. So, there we go. So we mentioned the new documents, and basically all of these regulatory changes hinge around those documents and the shift in liability. Does anyone know what the penalty is for knowing violations of this regulation?
Too much.
That is correct. Almost. It's $1 million per day for knowing violations. There's $1 million per day penalty for knowing violations. So this is serious business. And there are other tiers of penalties, but it can be up to $1 million per day in penalties. So again, you'll see a lot of that penalty and the shift in liability really driving some of these changes. And we'll talk about that more specifically regarding the closing disclosure. So I mentioned that the effective date changed. Initially, we were all marching towards August the 1st. That was going to be the effective date. And about 3 weeks ago, you saw a new date come out. They being the Consumer Financial Protection Bureau, said that October the 3rd would be the new effective date. And that's where we're all marching now. So in the press, you probably saw there was an administrative error. And what we've heard, basically what happened, the regulators have to submit a regulation 2 months before it can go effective. And they failed to do that. They realized it on June the 13th. So the earliest it could go in would be August the 13th. So they just moved it out to October the 3rd, roughly 2 months, and had that change occur over the weekend to be a Saturday. So where it sits right now in DC, it's currently in a proposed rule status. The majority of the lenders supported that change and for it to be on that Saturday, and it should be finalized probably next week. We'll see that final rule. We'll see October 3rd set in stone, and that's the new date that we're all marching towards. So here's how the effective date will work and how the pipeline will work. It all hinges on the application date. So if you have an application before October the 3rd, you'll continue to use the good faith estimate. You'll close on a HUD-1. You'll close on a HUD-1 regardless of when you close. Could be 3 or 4 months after, but if they have an application before October 3rd, you'll close on a HUD-1, follow the same process you do today. If you have an application on or after October the 3rd, you'll use the new loan estimate and you'll close on the closing disclosure. So it doesn't matter when the contract was, it all hinges on the application for mortgage, and that's the trigger for the change in the rules. So I'd encourage you, and I've mentioned the documents a couple times, if you haven't started getting familiar with them, start looking at them, getting yourself well versed in them, because you'll see throughout the regulation that the documents are intended to be used slightly different than the GFE and the HUD-1 are today. And you may have your customers and clients come to you with these documents for some guidance, and we'll get into that more. So start getting familiar with those documents if you haven't already. So I mentioned application, and the trigger for these new regulations is the application date. There's also a slightly different definition of application. So if you can't see these in the red box, I'll read them off to you. But when we as a lender receive these 6 data elements, we now have an application, and we're required by law to provide the customer this loan estimate. The 6 data elements are the borrower's name, their social security number, their income, the property address, the property value, and the amount that they want to finance. These values, we can't require verification of that to give them a loan estimate. We can't hold this loan estimate hostage until we see a W-2. A customer can come in and verbally provide these items to us, and we have to give them a loan estimate. The key word there is the estimate. And the reasoning behind that is the regulation wants the customer to be able to shop between mortgage products and between mortgage lenders. And if they're required to give a bunch of information and pay a lot of upfront fees, they can't really shop between lenders. Now, that's not to say that the customer cannot optionally bring in the documents to accelerate the process and head down the path as quickly as possible. So whenever I talk about the timelines and the different options, the customer can still head down the path of financing and to get a mortgage as quickly as they'd like, just like they do today. So most of these are maximums and options for the customer to use to take advantage of if they choose to do so. So how is this shopping going to be preserved? So a couple things. The fees that are disclosed on the loan estimate have to be honored for 10 days. So the customer could come in, get a loan estimate, theoretically shop for 10 days, and they could come back and say, I want to proceed on this loan estimate, and we have to honor those fees for up to 10 days. The expiration date is printed clearly on that loan estimate. And the other thing I mentioned regarding upfront fees, we can't charge upfront fees, the only exception being a credit report fee, until the customer gives us what's called their intention to proceed on a specific loan estimate. This can be verbal, some lenders may require it to be written, but again, preserving that shopping period to where the customer comes in and says, I want to go with this 30-year fixed product, let's head down the path, I want to get a mortgage with you. And then you can start charging the upfront fees, most notably appraisal. That's the biggest upfront charge, in the mortgage process. So again, if they didn't have this provision in, the customer could come in, and if they're paying for the appraisal up front, maybe less likely to go and shop around with other lenders. So how exactly will this shopping work? So the way the regulation is written, every loan scenario that the customer discusses with a lender is required to get a loan estimate. So if they come into us and talk about a 30-year fixed, a 15-year fixed, and a 5/1 ARM, we didn't have to give them 3 loan estimates. So similarly, they could come in, talk to one of our loan originators, get 3 loan estimates, understand what the fees, what the payments would look like, what the cash to close would be for each of those loan products. Then they could go to another large lender, have the same conversation, have 3 more loan estimates, and then go to a community lender and get 3 more loan estimates. Now they have a lot of paper, one, but they also have the information available to them from a fee perspective to look across products and across lenders and make a very well-informed decision on which loan product is best for them. And I mentioned this before, but I want to reiterate it. The customer is not required to shop. If they have a financial relationship with a lender, they can head down the path as quickly as possible. And with the closing times in this area, a lot of borrowers may not have the time to thoroughly shop around lenders. So they definitely are not required to do that, but it is an option to them if they choose to do so. The couple questions we oftentimes get in regards to this is, what exactly does this do regarding rate lock, the fee, the 10-day expiration, and the rate is not locked on the loan estimate. It's only the fees that have that 10-day expiration. Rate lock will continue to work just like it does today, and the rate is not locked for that 10-day expiration. It's just the rate at that point in time for the customer's credit profile that is put on the loan estimate and drives those payment schedules. Another question we oftentimes get is, what does this do for pre-approvals and pre-qualifications? The answer is it doesn't change them at all. So here's the way I think about it. Customer would come in, get a pre-approval or pre-qualification. They do not have a property address. Item number 4 here, required to be an application. They do not have a property address whenever they get that pre-approval and have not selected a property. They work with their realtor to go out, select a property, they go under contract, they now have a property address, right? So they would shop for a home on the pre-approval or pre-qualification just like they do today. They select the property, they go under contract, we now have a property address, we now have a Respa Tila application, and they would get the loan estimate, and they could shop for a mortgage if they choose to do so. So they'd shop for a home on the pre-approval, pre-qualification, they'd shop for a mortgage on a loan estimate if they choose to do so.
So they don't have to use the person that they put into it first, correct?
So they could get a pre-approval at one company and get a mortgage at another company, absolutely. Any other questions on the loan estimate? All right, so we'll move to the closing disclosure. And the closing disclosure is where most of the changes occur in this regulation. So the big change in this rule is the closing disclosure, which remember is replacing the HUD-1, must be received by the borrower at least 3 days before closing. Pretty big change from today where the customer probably gets the HUD the morning of closing, maybe gets it after the scheduled closing. Federal regulation, they have to receive this closing disclosure 3 days in advance. Now on the seller side, the only requirement for the seller to receive it is at or before consummation, and the regulation defines consummation as when the borrower signs and becomes obligated to the lender, so think signing for the borrower. Seller just has to get their closing disclosure at or before consummation. The other big change, I mentioned the shift in liability. The lenders are now accountable, responsible, and liable for the closing disclosure, unlike title. So it's a lender's decision on if they generate this closing disclosure. I've not heard a lender, and I'd definitely be interested in any of our title partners to your thoughts on what they've heard, but the lenders will be generating and providing this closing disclosure. It goes back to the $1 million per day. We have to know, one, was the closing disclosure delivered on time, which we'll talk a little bit more about, and was it accurate? The fees, etc. It has to be accurate, and the lender's liable for that. And because of that liability, the lenders will now own the closing disclosure and deliver it to the customer. Big change from today, where it's title or escrow that typically does that.
Quick question, if I could, on the $1 million. I assume that's going to the government, the fine. Just sounds to me like a lawyer employment application.
Yeah, so the $1 million is what we are liable to the regulators. There's also a private right of action, so the lawyers will be doing pretty well. But yeah, it would go to the CFPB.
How about when you tell your clients to use the HUD for your taxes? Now what are you going to tell them? Are they going to be a different CD paper, or are you going to use the closing paper? What are you going to use?
Yeah, it would be the closing disclosure, because the HUD one's going away.
People couldn't hear her question.
Oh, so how do we guide the clients to use, today they use the HUD for tax purposes or other purposes, we can include in there as well. What should they use tomorrow? And it would be the closing disclosure. The HUD one is going away, and you actually cannot use the HUD one after this goes into effect for closed-in transactions.
So just a quick statement, I actually heard that realtors are also going to be on the hook as well. So you know how you all do your inspections, and then we don't disclose them on the HUD because they're not on the contract. Well, those fees are now going to be considered part of your closing. So you guys got to be careful. I mean, there's a way around it, obviously, as listing agent does everything up front to the property before it gets onto the MLS. And then that way, none of those fees are disclosed because the seller isn't paying for them or the buyer's not paying for them. So you have to be aware of that as well. And then we also heard that the first 3 months, there's going to be a lot of lawsuits. Because there's a bunch of attorneys that are all over this right now, and they will contact the buyers and ask to see their closing statement. And if there's anything out of the ordinary on those closing statements, you will see lawsuits starting to happen. So they expect a lot of them within the first 3 months. And they're going to go after everybody, not just the lender, realtor, and title companies. So you guys just need to be aware of that as well.
Great point. And earlier this week, Director Cordray, who's the director of the CFPB, was on the Hill with the Senate Banking Committee, and the Banking Committee was pushing for a hold harmless period, they typically call it, where basically they would not hold the industry liable until a couple months later, once we're able to operationalize it, fully understand the impacts. But to your point, that's only one piece of the puzzle. There's still private right of action. There's still attorneys who, to your point, are lining up, preparing for this just like we are in the industry. So the 3-day waiting period is a really big change for the industry. And again, customer front of mind. The regulators want the customer to be able to look at this closing disclosure, know exactly what they're getting into before they go and sign. They don't want them to get to the closing and see the HUD or the closing disclosure for the first time and feel pressure to sign if they're not comfortable or aware of what's on the document. So I want them to get it 3 days in advance and have time to review it themselves and with their trusted advisor. So the 3-day waiting period is required all the time, no exceptions. There's also instances where an additional 3 days will have to be added. If there are what the regulation defines as material changes, an additional 3 days has to be added. How this is defined is if any of the 3 items listed here are triggered, they're an increase in the APR by more than an eighth, a change in the product, or an addition of a prepayment penalty. Prepayment penalties, for the most part, don't exist very often anymore. So this one should not really come into play too often. Let's talk a little bit about APR and product. When we did an analysis on this, we found a few things. One, it doesn't happen that often today, where changes in the last week or the last 3 days actually trigger APR or product. The other thing we found that I thought was interesting is majority of the time, these changes are initiated by the customer. And here are a couple examples. They want to change their loan amount, which could change APR. They want to change their product. They're headed down the path on a 5 or 7-1 ARM. They want to switch to a fix because they're fearful of what rates may be, in 3 or 4 years. They're oftentimes initiated by the customer. So what we're doing is we're coaching our sales team. We're coaching our closing team. So when we get a request from the customer to make one of these changes, we're able to inform them as best we can to say, you can make this change if this is what you want to do, because we want you to be happy, we want you to be in the product you want to be in. However, you need to be aware that if you change your product, you will not be able to close if you're within that last 3 days. And by the way, you still have your contract that you have to worry about. So I encourage you to do the same thing. If you hear your customers and clients, kind of on the fence, between an arm and a fix, we'll just use that as an example, have them get comfortable with that well before a couple days before closing. Because if they do make that change, it's federal regulation, they have to wait an additional 3 days if they change their product.
That's non-waivable by the borrower.
That is correct. This is not a waivable 3-day waiting period. The regulators have not described this not as a consequence, but as a feature of the regulation. And the theory is, if they change their product, they need time to think about that and review it an additional 3 days. Okay, now less significant changes that don't impact APR or product, which are the majority of changes that happen within the last week, you don't have to wait an additional 3 days. You have to update the closing disclosure and have closing disclosure finalized before they sign. So you can update that, and provide it to them at closing. So think seller concessions coming from a final walkthrough. Those typically do not impact APR. If seller takes the dishwasher, when they move out, they weren't supposed to. Seller gives the buyer $500. Simply all that has to happen there is you have to get the closing disclosure updated, get it to the borrower before they sign. That would not impact the APR, and that change can be made within the last 3 days. What I caution you on, though, is I mentioned that the lender is now on the closing disclosure. That means the lender is going to have to update that closing disclosure. So we could receive that information through a variety of different ways. Title, you could inform the title agent, and they would inform us. Or you can inform your loan originator directly, and we can make that change, get it updated, and get it right back out to closing. But again, those changes, the changes that typically happen in the last week, should not impact the APR product. But I encourage you, if there's any opportunities that you can think of to where you would have a change in fees, an addition of a fee, get those made as quickly as possible. Now, obviously some things happen very close to closing, so just be very clear, consistent, and as early as possible in your communication, title, lender, etc., to get this document updated and to relieve as much pressure as possible leading up to closing. You'll see, and we'll get into it in the next 2 slides, the communication and collaboration between us here in the room is going to be enhanced significantly from where it is today. And honestly, it's probably long overdue, especially the collaboration between lender and title. It's really going to be transformed after this regulation goes into effect, and I'll just put that out there for a teaser in 2 slides. So,
Inspections.
So that should not impact the APR. You can add that.
And so like if you do inspections and your buyer pays for it, and it's not included into the new POC. Yes, thank you. Then you don't have to worry about any of these.
That's correct.
And then if closing, because closing they say is going to take longer now, so now you can put 45 days or sooner or something like that to cover your butt so that you can make sure that it's going to close on time?
Yeah, so let's hold that and come right back to it after we talk through this, because the 3-day waiting period is just the first piece to take into consideration. The other is, there's what's called the mailbox rule, and honestly, it's probably the hardest part to grasp in the regulation, because it doesn't really make a lot of sense, in my opinion. So I'll tell you what the rule is. I'll give you my best attempt to rationalize it, and I'll tell you what many lenders are doing to fit within this. So, if I don't have a pointer. So, on the slide, I'm assuming you can see it, we've outlined the 3 days that I described on the last slide that you have to have before closing, and you have to wait. This cannot be accelerated, it cannot be waived. So, if you're going to close on a Tuesday, the customer has to receive it on a Friday, 3 business days before. That's 4 days on the calendar because Sunday does not count as a business day. Federal holidays also do not count. So keep that in mind as well. So you want to close on a Tuesday, you have to have it received by the borrower on a Friday. What the mailbox rule states is regardless of how the document is delivered, you have to assume it takes 3 days to get there, i.e. assume you send it through USPS, which is why it's called the mailbox rule. Now, you can accelerate this 3 days if you get an acknowledgement from the customer that it's been received. So what we're doing, and I think it's pretty representative of what the industry is doing, you're going to have to start marching towards having this closing disclosure complete a week in advance. So you can deliver it. It takes 3 days to get to the customer. It takes 3 days to be reviewed. Now, I mentioned that you can accelerate this 3 days, the 3-day delivery, which is referred to as the mailbox rule, if you get the borrower's acknowledgement that they've received it. So, standard process, we would march towards having it completed a week before the scheduled closing. You would send it. You don't have to get an acknowledgement from the borrower that they have received it because you can assume it's been received through the mailbox rule. And then you wait 3 days and you close. If you have to accelerate it, there will be a separate process. Our process will be we'll be able to overnight the disclosure, get the borrower's acknowledgement that they've received it, and then you wait for 3 days. So here's why I don't think it makes a lot of sense and it's hard to grasp. In today's day and age of communications, to assume it takes 3 days to get there just doesn't make a whole lot of sense. Here's what doesn't: assume acknowledgement that they have received it. An email receipt does not assume that they've received it. The regulator has said, how do you know it wasn't a non-borrowing spouse that opened that email that generated the email receipt that you received? Or an overnight signature receipt, how do you know a neighbor or a child or a son or daughter did not sign whenever it was sent overnight? You'll see lenders, how they'll evidence that they acknowledge that the customer has received it may vary. Some lenders may require them to just sign the document, send it back into them. Some lenders will accept a verbal. We're one of those. We can verbally acknowledge over the phone or in person that they have received it to shorten those 3 days. So let's walk through kind of the exception process. Okay.
I can't mentally get past the point you said. They receive it on Friday and then they can close in 3 days.
Correct.
Are you calling closing signing?
Signing.
When they get it Friday, they can't sign it yet. They have to wait for 3 days.
That's correct.
So it isn't closing at all, it's signing.
That's correct. This is not when it's recorded. This is consummation. The reason we've not put consummation is because it means different things in different parts of the country. So this is when the customer signs and becomes obligated to us. It's not recording.
And then if they can, if you put this forward, then they can sign earlier. So if you send it out on Friday and they close on Monday, if they say that they want to close on Monday?
No.
They have to wait for 3 days.
They have to wait for 3 days. This 3 days cannot be shortened, cannot be waived. This 3 days can be accelerated. So let's walk through an example. So let's go back to the Tuesday line we have here. If you want to sign on a Tuesday, customer has to receive it on a Friday. No exceptions to that. You could deliver it on a Tuesday, assume that it's been received on a Friday. You don't have to get the customer's acknowledgement that they've received it. You assume that they received it 3 days later. The other way that we can evidence that they have received it, the first way being telling the regulator, we sent it on Tuesday, we assume they received it Friday, they signed on a Tuesday. Let's take the overnight delivery scenario and play that out. Let's say we overnight the disclosure on a Thursday. It gets to the customer's house on Friday. We can get an acknowledgement from them that they have received it on Friday. When we have that acknowledgement, we know that they received it on Friday, we can close on a Tuesday. Here's the problem, why that has to be the exception process. Believe it or not, sometimes customers don't answer the phone whenever we call. I don't know why, but they don't. So if you don't target to send it out on Tuesday, you're going to really blow up a lot of your closings. Because let's go back to the overnight. Say we rely on that as our standard process. If we can't get a hold of them on Friday, and acknowledge that they've received it, and we can't get a hold of them until Monday, the earliest we can close is Thursday. If we can't get a hold of them Monday, we can't close till Friday. So that's the delivery and the challenge that we have in the lending industry. We got to get this closing disclosure finalized basically a week in advance. Okay, I talked about the change in how lenders and title are going to be collaborating. Here's the big change. Today, typically we collaborate through phone, fax, and email. There's a new product which Really See Technologies has developed called Closing Insight. Lenders who have publicly stated they're going to be using it are ourselves, Wells Fargo, and Union Bank. So a very large portion of the industry, and there are other lenders who are going to be using it but just haven't publicly stated it. This basically will replace the phone, fax, and email back and forth that we have today on the HUD. We'll continue to pass the closing disclosure back and forth between us to finalize it through this portal. And then once it's finalized, the lender will take it, send it to the customer. The other thing I would add here, we're going to start this collaboration roughly 10 days before the scheduled closing, much earlier than we do today, because we have to have, call it 3 days from 10 to 7 to collaborate and finalize the closing disclosure, send it out a week in advance to hit the closing. Now, this portal, there's a web-based version, so if they're independent title agents, they can simply register and use the web-based version to collaborate with us. The national title providers, the Fidelis, First Americans, etc., their software will be integrated right into the Closing Insight product, and they can collaborate with us through their software in the background. Honestly, this is an efficiency play that is long overdue. So the collaboration between lender and the title industry is going to be significantly improved and changed after this goes into effect. Heading down the home stretch here, I got the 2-minute warning about 10 minutes ago, I think. But here's what I'll leave you with. Couple call to actions for you. One, I mentioned the Closing Insight portal. If you work with a title agent on a lot of your deals, ask them, one, are they familiar and aware of these Respa or TRID changes coming? If they're not, find a new title agent. Secondly, ask them if they're ready to use this Closing Insight portal, regardless of which lender they're using it, because a large portion of mortgages will be going through this portal, and they need to be ready whenever this goes live, so we don't have to worry about that when we're trying to hit a closing. And additional information can be found in this link. Secondly is the BofA Agent Resource Center. We have a whole host of information out there, an entire section dedicated to this. We've got a webinar where we basically cover similar information that's available for replay out there that you can listen to, with communications that we sent out to title agents regarding this change, basically frequently asked questions that are a really great resource. And then the last link is directly to the regulator's webpage. The CFPB is the regulator who is, has created and will be enforcing these regulations. Every lender, big or small, across the country. So it's not a Bank of America thing, it's not a big bank thing, it's a mortgage thing for the entire industry. And they've got an entire page dedicated to the implementation, sample forms, 1,900 pages of regulatory text, all kinds of information out there. So I know we've come to the end of our time, but do we have time for a couple questions that may be out there?